things remote, and Rob will kind of hold down the fort there in the room. Tony, thank you very much for checking in. Also out of Northern Virginia, looking for deals. I think we can all agree deals aren't exactly laying around on the ground, so we've got to work a little bit to find them. That is why we do this and why it really is so powerful to get together, both in places like this online and just as important actually in the room together. I'm really looking forward to getting back into town and hopefully getting the body count higher in the room so that we can kind of chop it up after these meetings and talk about what everyone is up to. But in the meantime, for those of you with me here online, put your information there. I'll get that jotted down so that we can stay in touch. Find us both on Meetup, where you may have found this meeting tonight. You'll find us on Facebook. We can throw a link up later to our Facebook group that is free to join. Highly encourage you to do that. You'll see people posting deals there, asking questions there, networking, getting referrals and recommendations. That's really what the power of a network is, where you can get deals and information from your fellow investor. So be sure to check that out. All right. So I will let you all continue to kind of post your personal information here in the chat box. And again, as we're going along, feel free to unmute. This is meant to be a discussion. This is not really a strictly educational type of presentation, although we do hope you come away with a little bit of information. Mostly what we want to do is just kind of talk about what we do, and we choose topics that we're personally engaged in. So we just kind of talk about what we're doing in the business, and hopefully it will be of some use to you. Which is where we get into the legal mumbo jumbo. Not an attorney, not an accountant, not telling you what to do, but just telling you what we are doing. And as always, anything you pick up in any kind of a meeting like this, or anyone you meet, or any deals that you talk about, you always want to vet and protect yourself and do all your own due diligence. With that said, let's get talking about our topic for this evening, which is kind of alternatives to the traditional way of getting your deals done. So we start earlier in the year with talking about kind of how we find deals and marketing and networking and lead generation. And then we talk about how we estimate our deals and what our projects look like when we're flipping for resale versus just fixing a house up for rental. And we kind of talk about our levels of renovation. We talk about how lending and hard money works. I know our good buddy Chip is there in the room with Rob. So if anyone has any questions while we're talking about this, about how lending works and leverages and ratios and all that stuff, we've got an expert here with us tonight who can talk about those kind of things. But the main topic for tonight is how you can use other people's money in a way that's not necessarily even directly lending to or borrowing through a lender to fund your deals, including real estate syndication. And sounds kind of exotic, but all syndication really means is partnering. It's partnering with other people to get your deals done and using either their money, their skills, their resources, their capital, whatever it is, to help bring about your deal. You, as the what are often called the sponsor of your project, may be the one bringing the deal, but you may be looking for other people to help fund it. So that's what syndication is. It's when you're getting other people who are typically strangers to you, as in not your direct friends and family, to invest with you in your deals. It raises some of the levels of information that you have to provide. We'll talk about that in a second. But that's basically what syndication is.
Hey, Mark, can you hear us okay?
I can hear you great.
Awesome. Hey, just real fast, Chip, introduce yourself. And then I'd love for you to introduce, what was your name again?
Dinesh.
Dinesh. I remember you being here last time, Dinesh.
Right.
Okay, okay.
Yep.
So is it okay?
Yeah, we can hear you. Go ahead.
Okay.
Sure. I'm Chip Shear. I am primarily in the private lending space. I've been in various forms of real estate investment for really about 30 years. So have a variety of different experiences, not only in the syndication realm, but in the deal structuring, investing with IRAs, all that good stuff. With the topic, and I am anxious to participate wherever I can.
Yeah, we can, if the internet's stable. Dinesh, go ahead and introduce yourself.
Hey guys.
Well, now I feel terrible for Dinesh. We froze up right when Dinesh was saying hi. I remember he was in the room last month. Oh, there he is.
Yeah, Dinesh is oh, I don't
Go
know.
ahead. I can hear
Dinesh
you.
is expanding his portfolio. He's a newer investor.
Awesome. Good deal. Yeah, we get you in good spurts there of about 30 to 45 seconds. So when you want to jump in, make sure you squeeze it in that 45 seconds, Rob, while the broadband sticks with us. But good to see you, Dinesh. And thanks everybody for hanging out with our brave new internet connection here. But as I was saying, syndication is a way to partner with other people that you don't necessarily already know, that may be strangers to you. It results in a different level of information sharing on your part that we'll talk about in a second. But the other kind of broader topic that we want to talk about in addition to syndication is the self-directed IRA or individual retirement account to allow you to fund your deals. And hopefully we'll get a reasonable enough stable connection over there that Rob can jump in a little bit and talk about how we're using these self-directed IRAs to get deals done, because we are using them right now to get deals done. You can buy houses, you can lend to people, you can lend to other investors to help them do their deals directly from a self-directed IRA. And that IRA can be either the traditional kind of IRA where you pay taxes when you eventually take the money out, or it can be a Roth IRA where you pay taxes or you use after-tax money to fund it. And then that account grows tax-free and you can use it and take money out of it tax-free. Incredibly powerful way to make money. And I encourage everyone to look up Peter Thiel, the angel investor hedge fund guy from California. I think he funded like Facebook and a bunch of other stuff. He made $1 billion, I think, on his PayPal or Tesla, one or the other. He knows Elon, on one of his two investments, entirely tax-free by investing like $5,000 or $10,000, some nominal amount of money in a Roth IRA, but then using that money to invest in the shares of whichever one it was, PayPal, Tesla, whatever it was, made $1 billion tax-free in a self-directed Roth IRA. The potential is really limitless for what you can accumulate in a self-directed IRA. Speaking of which, may be a good time for me to ask those of you here, does anyone here have currently a self-directed IRA? If you do, maybe say so in the chat. And if you wouldn't mind and you're willing to share, maybe share who your self-directed IRA is with. I can tell you Rob and I have them with Equity Trust, and we can maybe throw up links to them. Tom looks checking in Equity Trust as well. So we can talk about how that works. Rob, is that you saying you're buying Ether and Bitcoin in your Equity Trust account? That's awesome. Rob is dipping into cryptocurrencies in his self-directed IRA. That's the beauty of the self-directed IRA, with certain limitations on who can benefit from the IRA and what names can be on things. You have a pretty wide ability to invest in different kinds of investment vehicles: stocks, bonds, obviously real estate, cryptocurrency, a lot of different things. They're pretty cool. Let's see if we actually talk about that a little bit in some of these slides here. And you can combine these two concepts, right, to really transform your real estate investing potential by using other people's money with the syndication process, a little bit of your own money with the self-directed IRA, either before or after taxes, and really have a tax leveraged ability to invest in real estate. And Anika saying, looking into Equity Trust, but open to exploring another custodian. We have a few that we're aware of. And if anyone wants to throw in there, Rob, if you got a minute, there are a couple of others that we're aware of. Equity Trust is kind of the big player in real estate investing circles for self-directed IRAs. I've had them before with Millennium Trust, more for stock and futures investing, just the different custodians. That's what these places are called, by the way. Equity Trust is what's known as a custodian. Sounds like Madison. Yeah, Madison's another one. Millennium is another one. What these guys are as custodians are kind of like the gatekeepers. They're the guardrails of using your self-directed IRA. And as Mark has just said, setting up checkbook access. Looks like he's using Rocket Dollar is important. And that's what these custodians do. They allow you to place your money with them, but you get to choose where you invest, again, subject to certain rules and restrictions. The biggest one being that everything has to be invested, obviously, through this IRA. So you don't invest as Mark Beckett or Rob Chavez or even your LLC. You're investing as the Joe Smith IRA, and whatever the account number is the actual name of the buyer if it's participating in the purchase of a thing, of an asset, or as the lender if it's lending money to another person. So you're lending directly through the IRA, and your custodian will help make sure that you're doing that and having everything kind of written and drafted correctly for the IRS, who are the ones who really care about how you use these, because again, it's tax advantaged. You have to follow the IRS rules. And the other big rule, in addition to just making sure that you name everything properly, is that you do not lend to your friends and family. If you want to use friends and family money, we talk about that with partnerships. We can get into that with the syndication. But what you can't do is lend money to your wife or a friend or anyone else other than actually, you can't lend to a friend. You can't lend to a family member. They have to be an arm's length type of transaction to you. You cannot buy, for instance, a property from yourself in your IRA. It's not like a way you can kind of wash your flip house profits into your IRA. You'd have to do it a different way from the beginning. And the way that we've done it that is legal is you may not be the owner of that property, but you can lend money to your partner who is the owner of the property, and they get some of their funds from maybe themselves and their own bank account. They can get some funds from a hard money lender like a CHIP. They can get money from friends and family that want to lend to them with a regular lender agreement, but you can lend to them from your IRA as the lender. Work out what your participation is going to be, what that investment is going to be worth, what your return on that is going to be. And then when the investment is done and sold, you get your piece sent back to your IRA with your return. And again, that return can be whatever you work out. So you can lend $5,000 from your IRA to someone's project. And if you did it for a split of the profit and your split of the profit was $10,000, good for you. You just made a 200% return, lending 5 and bringing back 15 at the end of the day when the deal pays off. There is no limit on what the return can be on your lent funds. Again, that's the other reason that they're so powerful. You can take a small amount of money and turn it into a very large return, tax advantaged. So that's one of the things that you can do with those self-directeds. And yes, you can't lend to yourself either, as Rob is saying in the chat. I cannot take my IRA and lend it to me personally or to my LLC. It has to be that disconnected arm's length transaction. Self-dealing, that's right. Thank you, Mark. It's called self-dealing if you lend to parents, children, siblings, that kind of thing. Well, I don't know, Mark, you're saying horizontal brothers and sisters are okay. Maybe. Definitely check with your custodian. But again, that's what they're there for. A good custodian will also answer all of your questions when you say, hey, I want to buy a house, or I want to go in on a deal with somebody, or I want to lend to this deal. How would that work? And they are there to help make sure that your setup is correct and legal, and it doesn't get your IRA shut down, or worst case scenario, fully taxed, which we obviously don't want. So check with your custodian on how those things can work. So another example here of kind of how things work. I find a deal for $1 million. And if I have found the deal, I am generally called the sponsor of the person bringing in the deal, right? So as the manager or sponsor or operator of whatever you want to call it in the deal that requires $1 million, I can put in, for instance, 5% of the required equity or $50,000 and raise the remaining 95% from investors. As the sponsor, I'm responsible for managing the operation of the deal, getting it closed, getting the property bought, getting the contractors, if the property needs development, on board, managing that process, managing the sale, the rent, whatever the outcome is of the property, in exchange for my piece of the deal. And my investors then on the deal would get whatever we negotiate as part of their investment operation. And as Rob points out, that 5% that I'm putting in can come from a self-directed IRA if I'm trying to do it in a retirement account for that tax advantage. By the way, understand when you're using that IRA, it is for retirement, right? So no matter what the return is and whether it's a traditional IRA or Roth IRA, and whether you own the property or have lent to it, whatever the deal is, that those are retirement funds. It's not money for you to be able to use today. So if you're looking for income today, you would want to either split the funding, some from an IRA, some from an operation account that would be regular income, taxed at the regular income rates, right? Depending on whether it was a 1-year hold or longer, to determine whether it was regular income or capital gain. But if you wanted to make today dollars, you do not want to use your IRA. This is for building retirement funds. So getting back to how you might structure this large deal, let's just start with kind of the easiest, the straight split structure of a syndication. And that means everybody gets the same returns. Whatever the number is, divide by the number of people going in on a deal. And that is how we distribute the profit and losses from the sale. So we're going to say here straight split using an 80-20, meaning that 80% of the returns go to the partner investors and 20% goes to me as a general partner. As the person who syndicated the deal, that means 80% of, if this deal makes $100,000, $80,000 goes into the investor pool, $20,000 stays with me as the sponsor partner of the deal. And Rob, stop me if I stop making sense with any of this. The other advantage to syndication is your other partners are what are known as limited partners or passively invested partners. Their risk is limited solely to what they have invested, as opposed to if you buy a property entirely on your own or you borrow money from a lender. They may say, great, well, you're signing on the dotted line for this loan. Whoever signs on the loan is ultimately responsible for paying it all back, win, lose, or draw. And in the event of a loss, that person signing up for the loan would be responsible for the loss. Limited partners are usually limited in their liability and limited in their risk, their capital risk, to what they've invested, as opposed to the general partner, who in exchange for this, in the case of my example here, 20%, usually does take on a larger liability, both for the debts of the operation and legal liability for all the other things that you're signing on for. Limited partners do not. That's why they are called limited partners, and that's the advantage to them. So those splits are the same, whether there's $1 or $100,000 in return, or whether there's a return or a loss. The split is the split as it is set up at the beginning. So that 80-20 split, 80% of the return goes to my limited partners, 20% goes to me for setting the deal up. Let's see here. It says deal structure especially beneficial to passive investors with high deal returns. It's a benefit to anyone as a limited partner who is looking to limit their exposure and hopefully get a decent return on their money. Getting a little more exotic, you will hear people use terms like waterfall or preferred returns for a syndicated investment. Basically, what that means is instead of just a straight, we're just going to buy this thing, we're going to try to fix it up, and we're going to try to sell it for more money than we have into it. And then if it makes 100 grand, 80 grand goes into the pot to you investor types, 20% goes to me as the general. Waterfalls and preferred returns set up returns that benefit your investors first, so that the first, say, 10% of profit goes to the investor. So whether, again, it's $1 or $100,000, in the case of $100,000, 10,000 goes into the investor pot first before me as the sponsor who brought this deal up and brought everyone into it makes a penny. That obviously is preferable to your investors, why it's a preferred return, because they prefer to know that they're going to be taken care of first when your deal makes money. All of these things are negotiable. All of the terms for who gets what and what the return is and whether or not there's a preferred return are all a matter of what you can negotiate between you and your investors. But just understand, if you're looking for strangers that you've never met before to invest in your $1 million project, you might need to do something more than just a straight, hey, I'm going to get 20% off the top and you can have the other 80 when and if this makes money, to get them to put their money with you. So that's what the preferred returns do. It puts your investors in front of you to make sure that they have at least a minimum amount of return before we decide what the split is going to be and before you as the sponsor start to get your money. Let's see. A question, can you touch on what is preferred return versus annual cash on cash return? Sure. So a cash on cash return or return on investment is really just a calculation of the profit over what it cost you to do the deal. So your cash on cash return, if this deal required $1 million that we're talking about, we're going to buy a 10 unit apartment building somewhere. It's going to cost us $1 million. And I've found 10 people to put in $100,000 to raise the $1 million. So I found the deal. I'm not going to put in anything. I've got 10 people putting $100K in each, and we're hopefully going to fix this 10 unit building up and then sell it. We're going to sell it in a couple of months for $100,000. If it cost $1 million to do the deal, and when we fix it up and sold it to another apartment REIT, they paid us $100,000 more than we've got into it. We've made 100 on our million, or 10%. 10% is the cash on cash return on the whole deal. A preferred return, though, refers to the specific return that you are paying that one investor based on what you agreed with them on their money. So if you've agreed to pay your investor, say, an 8% annualized rate of return on their $100,000, that means you've agreed to pay them $8,000 per year if their money's in for a year. That's the preferred return that you're saying you're going to guarantee your investor before you, as the sponsor, take any money. So I've told my investor over here, I'm going to guarantee you 8%. You've given me $100,000. That's $8,000. We make our $100,000 profit at the end of the day. That $8,000 goes into the pot for the investor that I promised it to, and that leaves $92,000 to get divided another way. And if you've promised that same 8% return to all 10 of those other investors, $80,000 goes into the thing to get paid out of that pot to your investors before anything gets split to you as a sponsor with your other investors. Kind of keeping that math the same. I've got 10 investors. I've promised them each a preferred return of 8%, make $100,000. $80,000 goes into my return, my investors' return pot. That leaves $20,000 left. And I said, all right, we're still going to do 80-20 of the what's left over after the preferreds get paid. Out of that 20,000, what's 80% of that? 10% would be 2 is 4,000. So 16,000 of the 20 also goes to the investors, and then 4,000 is what stays with me as the sponsor. So that would be an 80-20 return of the profits after a preferred return of 8% was paid to all the investors. If that makes sense. The way to think of preferred return is paid first. It goes into the pot to be split among your investors, however you promised it to them, before you get your cut as the sponsor of any of the profit. So hopefully that answered that question. If not, let's come back to it. We can talk more about how preferred return. I think this is just the written version of what I just explained. So syndication with an 8% preferred return means that first 8% of the returns or cash flow go to this says you or the limited partners. You as the general partner can participate in the preferred returns. Typically though, your investors generally are the ones getting the preferred return. And the bottom paragraph here is more salient. The general partner, or me in this case, Mark, would get a piece of the returns if the returns are above 8%. Once the deal makes at least an 8% return for other people, then you start to participate as the sponsor. Again, it's just a way to put your investors ahead of you to make sure that they get their money first. So again, to explain how the math would work, invest $100,000 into a syndication with an 8% return. You get your 8% or $8,000 out of that 100,000, and then Mark, as a general partner, does not get any piece of that. You get it first before I get anything. Let's see. This does not guarantee that you will receive the full 8% return. It does ensure that you will get the first returns up to 8% of what's available, right? So again, if you have preferred returns and the deal doesn't generate at least that 8% return for the general partner gets nothing. The preferreds get paid out first, and it makes sure that the general partner or sponsor of the deal, the bringer of the deal, is going to work hard to make sure that you get the returns above that minimum threshold to make sure that there's something left over for the good guy, for the sponsor that set it all up. So what happens beyond a preferred return, or when that threshold is reached? What waterfall means is that you add additional returns on top of that original first preferred return. And if the deal makes, between 8 and 14%, we're going to split that, 70-30. And if the deal makes 30%, Mark will get like an extra bonus on top because the deal made so much more money than we originally thought. Waterfall just refers to different ways to kind of chop up the profit that usually, as the returns get bigger and go up, you get a little bit more of a bonus to the sponsor that brought the deal. So I brought you into this deal telling you that we believe that you should be able to make an 8% return on your money, that 8,000 on your 100,000. But the market was great. I did a phenomenal job. I found a great property, did a great job of fixing it up. We sold it and it made 200,000 instead of 100,000. After you get your first 8% back, it goes to a different hurdle and say that next, X% of return, I now get, half of that. And if we made like a 25% return, everything after a 15%, now I get like 75% of that. And it really rewards the person who set the deal up for making larger than expected profit on a deal. So just think of waterfall as additional incentive usually for your deal finder when a deal goes better than expected. Let's see, once you hit the 14% threshold, then as I'm saying, the example, maybe it goes to like a 50-50 split. You can have different models, different thresholds. You'll hear the waterfall and gates, and all this means again is me as the general partner, as the guy who brought this deal up, who may not have as much money invested as my investors do. I'm trying to set it up so that you feel comfortable, so that you're getting a good return on your money at first, and then only if the deal does really well, even better than you expected, do I start getting some bonuses on top of the original split. That's what waterfalls and thresholds allow you to do.
Back it.
than is incentivized. Go ahead, Rob. I hear you.
Can you hear me okay? Or is there
Yeah,
an
I can
echo?
hear you. Bud. Go ahead.
Is there an echo?
Nope, you sound good.
Okay, great. Quick question. If somebody wants to get involved in a syndication deal, where do they find them? How does somebody find us?
So the more people you talk to, the more you'll find people looking to raise capital for a larger deal, right? Groups like this are where you will find people looking for deals, but you can find offerings online. Do you have a place in particular, Rob, that you look for people looking to syndicate larger deals?
No, I think the network is probably the best place, but there are different online companies like, which one, Chip? Do you know? Fund That Flip?
Yeah.
If anybody knows of any, put them in the chat as well. But there is High Rise, right?
Fund
High
Rise.
Rise.
Yeah. Is another one?
Yep.
Yeah, there are some places online. A lot of the online platforms, though, are really a little bit simpler. You just put your money in, they go out and invest with you and maybe 1,000 other people to buy a part of an apartment building or fund somebody's flip or that kind of thing. Most often where you'll hear people using the word syndication is just between a few people. Someone will come to you and say, hey, I've got this great deal. Would you like to invest in it? I will promise you at least a X% return if the deal makes money. And I get a piece if it does better than that. That's kind of what syndication is. And it's usually among local investors who know one another.
Yeah. And Mark, I think that's an important point. If I was giving somebody advice, which is sort of starting off, this concept has been around forever and this structure's been around forever.
Mm-hmm.
But I think it's important if you're starting off to look for this structure locally and look for something that you can see, feel, and touch. And then after you've been through a couple of them and you understand the structure, then you can sort of start to expand your horizon. It was a large new construction deal where the builder, who's really experienced, said, here's what I'm doing. I got the property under contract. I'm doing all the work. I'm bringing in 4 doctors. Each of the doctors is putting up 150 grand from their IRA. We're making a loan to the IRA. We're building the house. And they had a concept where the doctors were getting a preferred rate of return while their money was out. And then they had a split that was worked out that was fair to all parties. But you certainly had 4 doctors that could not build a house. And if things went awry, they were totally reliant on the builder doing what he said he was going to do.
Yep.
So, conceptually, it worked out great, but I think it would have been a real challenge if this was a condominium project in Colorado that you didn't necessarily know a lot about, and you didn't have a local builder that you can go and see, feel, and touch and see what progress was going on with the project.
Hey, Mark, the other thing is I want to say, I said High Rise before, but Chip corrected me. It's Fund Rise.
But Fund Rise, yeah, F-U-N-D Rise. And again, they have I think a slightly different even structure than just a regular LLP like what we're talking about here. But Chip's point is very well made. I don't know anything about these other platforms, and I obviously, again, we're not speaking as attorneys or accountant type people here. Mike just posted in the chat, he gets packets from a group called Ashcroft Capital every 3 or 4 months who are looking to fund large multifamily syndications. Chip's point is very well made. If it's your first time investing as a limited partner in something, I know I would feel better doing it locally with someone who I could better vet, find out what their local reputation was, find out anybody else I know has ever invested with them, know what it is that they're investing in, being able to drive by the property that you're going to invest in is definitely a major value point as an investor. But yeah, while this will work, you can invest passively through a syndication anywhere in the world. Highly recommend that you first start off with someone locally. And same thing if you're going to try to syndicate a deal, right? You're going to be more likely to find investors locally than if you just kind of go out on Facebook and say, hey, I got a great deal. Anybody want to throw some money at it? Working through a local network is going to be a better place to start.
Yeah, our friend John Rubino
Yeah.
does a lot of that here
Yeah.
locally. So,
Yeah, and he has stuff in Atlanta.
oh, does he as well? In Atlanta?
Well, yeah, he does high-rise multifamily stuff in Atlanta.
Well, okay.
Yep. Let's see if we can look him up, because that is actually a great example, and someone that we know from our network who does this, who we also know is really helpful to people who want to kind of talk about how syndication works and how the accreditation process works to become an accredited investor.
His concept is he's kind of the builder partner.
That's
His finance guy is a CPA, and
Yep.
his CPA has a long list of clients that all make pretty good money.
Yep.
Right. So they need place to park their money. They need tax preferred returns. They need somebody that they can see, feel, and touch. So it was a warm handoff where accountant actually raised the money through his customers, and John does the work.
Yep.
So conceptually, there's a million ways to put together. That
Right.
sort of work hand in glove, because the accountant is not going to be building big buildings. And it frees John from going out and sitting on individual meetings trying to raise, whatever, 50 grand at a time from individual investors.
That's right. Or trying to get it even from a bank, right? Banks have loan to value requirements, and they may not lend as much money as your deal needs. So you're still going to need to come up with some equity from somewhere. And that is also a common way that these deals happen. You can still get a bank loan, but the syndication is to cover the remainder of the capital required above and beyond the loan. So you still have partners, you still have the sponsor. You just also have a bank loan that covers certain percents of it.
Yep.
Annika also said in the chat that she gets emails from Dan Lesniak with deals with 15% returns. We know Dan very well. He helps run our group in Arlington, and he does condo projects and other bigger projects that, we do know that he runs these kinds of syndications to bring in his passive investment dollars. Again, passive meaning that you as the limited partner aren't engaged in daily construction briefings, although again, your deal can be that you do have some participation if that's what you work out with the sponsor who's setting up the deal. It's whatever you negotiate as part of your partnership agreement, or as we're saying here on this slide, that these are often set up as limited liability companies or limited partnerships. You then become that limited partner. There will be a general partner who is usually that sponsor or manager, or let's call them gal who finds the deal. The gal who finds the deal and sets it up becomes general partner and manager. Usually are the ones then they're going to be signing on loans, putting their credit at risk if that needs to happen somewhere. And you as the limited partner just put in a set amount of money, win, lose, or draw, and hopefully get your money back with your return as the project unwinds and gets done. The operating agreement is where all these things get worked out, right? Your waterfalls and your hurdles and your preferred returns and what risks that you're taking and what rights you have as an investor to show up with a hard hat and walk around the job site and check out this condo that you just invested in. All of these things will be dictated by the operating agreement, or what is also known as the offer agreement, that discusses all of your rights and interests in the venture. So that's obviously critically important that you read and understand. And if you have to have an attorney or an accountant look at it, that they go over that for you and check it out. And then obviously that means if you are going to be the sponsor, that these are critical documents for you to get right as the person looking for limited partners to invest in your syndicated deal. So you need to make sure that these are drafted by attorneys and looked over by accountants to make sure that what you're promising is doable and correct and legal and properly structured and vetted so that it will make sense to your investor and the people that they will have look at it. But all of those rights are dictated by those operating agreements. You want to make sure that they're correct. And then a kind of a breakdown of the two structures. A limited liability company will be looking for members of the company. You become a member in the LLC that gets formed to, for instance, buy a small apartment building. In a limited partnership, you are signing a partnership agreement that makes you a limited partner in the venture. Functionally, I don't think there are great differences to the investor. But again, have your attorney review these documents so that you understand what it is that you're investing in as the investor and what it is you're promising as the sponsor, to make sure that it's clear what people's risks are and potential returns are. And that's really what all of these documents are about, right? Spelling out the risk. What risk are you taking? What happens in the event of a profit? What happens in the event of a loss? What are the responsibilities of that manager or the sponsor that's brought this up? What percent of profit do they get just for existing? That happens too. There can be a management fee that the manager makes, whether the deal makes money or not. You get to decide as an investor whether or not you're okay with that. You get to decide as the sponsor who's bringing the deal whether or not you think you can get it. But things like management fees are common, and all of that gets dictated by the operating agreement, and everyone needs to be okay with it before you sign it and fork over your money. So who can do this? Who can put money into these things? You will usually see when someone is looking to syndicate or raise money, they will say that this is an opportunity open to accredited investors. What does accredited investor mean? There are some IRS and Securities and Exchange Commission dictated rules for who can participate in these things. And what they're basically attempting to do is make sure that you are an experienced enough investor that you understand the risks that you're taking on. Again, this is not a bank supported necessarily project. This is not backed by any kind of government. This can be a private individual saying, I want to buy a 10-unit apartment. It's going to cost $1 million. You want to put in a couple $100,000 to make 10 over the next 8 months. What do you think? You need to understand what risk you're taking as an investor to invest in this. So the government wants to make sure that you've done a couple of things in your life to be in a position where you can risk dollars on investments like this. So they're looking for you to have an income of $200,000 a year, each year for the last 2 years. Or if you're a married couple, a combined income of $300,000 a year for the last 2 years. Your sponsor or the person looking to get you to invest is responsible for verifying this information. W-2s, tax returns, pay stubs, account statements, somehow verifying that these things are true. Or a net worth of at least $1 million, excluding your primary residence. So if you've got $500,000 in equity in your personal residence, that does not count towards you becoming a quote accredited investor. You need to have $1 million in other assets, bank accounts, IRAs, other real estate. You can be in cars. It can be in anything that is an asset that has equity in it, but it cannot include your primary residence. So hopefully you're getting the point here that people who are allowed to be accredited investors in these syndicated projects tend to have some amount of experience making money, investing money, or having enough money that they can take a higher risk venture than just putting money into a mutual fund, right? This is definitely a higher risk venture than just putting your money in a certificate of deposit. You're betting on somebody's real estate deal. So the government protects you as an investor by making the sponsor vet you and make sure that you're qualified to take the risk. So
Mark, can I interject real fast?
Yeah, go ahead.
This is, one of the things I love. Let's jump back to a self-directed IRA.
Yep.
Somebody has a self-directed IRA, and let's say they have 150,000 in their self-directed IRA.
Mm-hmm.
This does not preclude them from being able to go directly to a private individual that's looking to do an investment and lending them those funds, right? You don't need to be an accredited investor to be able to do that. You can lend those funds to somebody in the form of a note, right? That's either secured or unsecured. I would always say, you want to lend those funds in a secured manner, meaning have a first deed of trust, right? A minimum, a second deed of trust, right? But you have the ability to lend those funds out. And I don't want people to think they need to be an accredited investor to be able to do that, because you don't need to be, right? You do need to be in order to be able to buy into these syndicated projects. And I believe that there's a rule where if the sponsor of that project has been introduced to you, right, as opposed to you marketing it to them, I think there's some wiggle room that's there. But that's a John Rubino question. I'd have to ask him.
Yeah, actually, I was trying to see if I can find John's contact information so I can put it in here, because he would be an excellent person to kind of dissect that requirement and who can do what. And I've found it, so I will get that posted here in the chat in just a second. JLD Investments is John's operation. So yes, you are right, Rob. You can, through that self-directed IRA, still lend money to people in different ways. But in order to be a limited partner or a member of a limited liability company through a syndication, you would need to be an accredited investor. And in order to verify that, that sponsor is probably going to want to collect some tax returns and W-2s. So you will have to provide some information to prove that you are able to take that risk. Let's see, I'm just going to say hello to Katie, checking in from Austin, says she's looking for deals and interested in learning more about syndications. Awesome. Welcome, Katie. Good to have you.
Welcome.
That's the fun of the internet. We do love getting together in the room, but on the internet, we can catch up with our friends from Texas. And those that don't know, good time to mention that we actually have these meetings in other parts of the world. Our Texas meetup location is out of Austin, right?
Yep. Run by Wendy Papasan.
Powerhouse investor Wendy Papasan out of the Austin, Texas area. We're as far out as Vacaville, California, and as far north on the East Coast, I think, is Philadelphia, and growing. So make sure you're following us on Meetup if you're looking to check us out in a town near you, if you're not near us. Okay, so accredited investors, though, just means that you have done enough in your life or make enough money that you can afford to risk a little bit of it on somebody's deal, and they make you prove it. So back to Rob's point then about self-directed IRAs, you can, I don't want to say avoid some of those requirements, but there are different requirements for the ways that you can use your IRA to lend people money using notes and other loan instruments that don't count as syndications, but they are then more structured as Rob said, personal notes, whether they're collateralized or protected or not, is something that, again, you get to negotiate with the person that's looking to borrow your money from your IRA. You may be able to get them to give you a first deed of trust or a second deed of trust or a third deed of trust. Those just tell you what position you're in the order of getting money back when a thing gets sold in exchange for your loan, whether it's from your bank account or from your IRA. The way it's collateralized is up to you to negotiate with your sponsor.
I think the rest of the slides, Mark, a lot of it is talking about self-directed IRAs, which you kind of started with.
Okay,
right?
good.
There, I think there's some slides in there talking about who you can lend to, and who you can't.
Let's do it. I guess, does anyone have any questions, though, about that syndication process and being an accredited investor and what you need to provide someone in order to take investment funds in through a syndication to fund your deal? And I'll let people think of
some questions.
Think of a question if they have it while I put in some. Buddy John.
Question. So this kind of self-directed,
Yep.
is it more for flips or is it for long-term? What is it?
You could do both, right? But a lot of people do it for flips, right?
That's what.
Yeah, a lot of people do it for short term, because otherwise you're buying, which I purchased. I own a house in my self-directed IRA. But it's better to turn that money multiple times in a year. So I'll lend out of it and I'll do fix and flips out of it. That's a great question.
So I'm posting in the chat, name and email for our buddy John Rubino, who does this, who syndicates real estate projects here along the East Coast. I think as far down as Atlanta, as Chip was saying, and is usually pretty happy to answer anybody's questions about how the syndication process works. Not vouching or vetting for him, just know that he's a good guy, very helpful, and has been doing it for a while. And I think has got some pretty interesting investments. So his information is there if anybody wants to ask him more about how syndication works. So self-directed IRA, as Rob was saying, a lot of people use to either buy their own real estate or to invest with a partner or someone looking to raise funds for a real estate deal. First thing you need to do is open an account, obviously, with one of those custodians that we talked about. Equity Trust, a good one. Again, not vouching for them in particular, but we've used them. They do allow pretty easy access to the money. I think it's what, Rob, a 2 to 3 page thing that you fill out directing where the money is going and what the instructions are for how to invest the money. So it's relatively easy and pain-free to do. That's kind of the step 3, where you provide your self-directed custodian the specifics of the property that you want to purchase or the loan that you want to make to someone and where to send it, and what documentation is required in order to send and receive the funds. And then wires go out from your self-directed IRA, or if you have what's called checkbook access, you can write a check directly from the account. It goes on deposit, either with the person that you're loaning the money to, or send it to the title company to buy the property, and you are in business.
Hey, Mark, one
Yep.
thing that we haven't talked about in here
Yep.
is the tax benefits of setting up a self-directed IRA. Why would somebody want to set it up and funnel money into the self-directed IRA from a tax perspective?
So, yeah, what I was saying at the beginning is the 2 main kinds of IRA that people use is a traditional IRA and the Roth IRA. With a traditional IRA, the money grows tax-free, but you pay taxes on it when you take it out. With the Roth IRA, you use after-tax money to fund it, but then you don't pay taxes on it when you go to take the money out. Why someone would want to use one versus the other, I would say if you are nearer to retirement, a traditional IRA typically makes a bit more sense because you can accelerate the amount of money that you can have working because you're taking pre-tax money to fund it. But if you're looking at a longer time horizon, you have more time to add more money to this IRA as you get it, or more time to let it grow. The Roth IRA is extremely powerful because then you don't pay taxes on the money when you go to take it out. So if you've grown it to hundreds of thousands, millions, or billions of dollars, in the case of Peter Thiel, you're not going to pay taxes on it when you go to take it out. But you're going to have to use after-tax money to fund it today, right? So the government will already have taken their bite out of it before you get to fund the IRA. If you believe that we are headed into a high inflation, high interest rate environment over the coming decade or two, a Roth also starts to make sense because some people would say, well, all of this money we're spending to save economies and help people and do things is eventually going to need to be paid for by a higher tax rate. And if the tax rate is higher in 10 years, you'd be better off paying your taxes on it now, making money. And in 10 years, when you go to take it out, if your tax bracket goes from 25 to 50%, you're in the clear. You're not paying that higher tax bracket when you take the money out of the Roth IRA because you used after-tax money to fund it to begin with. But the main point is with IRAs is that they are tax-preferred vehicles. You're not paying taxes on it today, or you're not paying taxes on it when you take the money out. So that's why you would use the IRA because it reduces tax liability. That kind of
answers the question. Yep.
Okay.
And if people want to fund it without the taxes going in today, right? They're gonna do a traditional, I think they have the ability to put in what, 50,000, 55,000?
Depends on your age. Yep.
Yeah.
I think it's as little as like eight or 12,000, but it goes up the older you get, the closer you get to retirement age. The government allows you to put more money in. A Roth can
Yeah, it'd be
have,
like 20% of your income you have the
Correct.
ability to put in.
there are income requirements.
Yeah.
Roth IRAs have different requirements. Topic for another night, but there are structures called backdoor Roth IRAs that allow you to put more money in than you might otherwise do it. Feel free to look up on your own time, backdoor IRA, to increase the amount that you can fund your retirement account. But the basic premise is that this is not for today income. This is for future retirement income. So obviously you're not using that money today except to invest in. So know that this money will be for future use. That's why it gets the preferential tax
And let
treatment.
me just tell Dinesh something real fast because it answers his question. So a lot of my friends will lend their self-directed IRA money as hard money, like as private lenders, right? So they'll earn somewhere between 10 and 12% plus 1 or 2 points, sometimes more, and they'll just consistently turn that money in their self-directed IRA. Such a great tool. Or what will happen is somebody like Chip will talk to somebody like that has that self-directed IRA money, but they don't have the time or the resources to deploy that capital. So they'll use somebody like Chip to bring them the deal, right? Bring them the person, and then those people fund it. And then he makes a little bit of a spread between the two for connecting, right? Right? Basic idea? Okay, cool.
Yep.
Very powerful. I love
And the last point here on this slide, the step 4, manage the investment in your account. Critical detail, if you are owning real estate, for instance, in this self-directed IRA, all of the profits, all of the expenses, all of the cash flow in and out needs to come through the IRA. You can't commingle with your personal funds and your IRA funds. If the IRA owns the property, the IRA must pay for everything, at least for your part. You can be invested with other people, but you cannot commingle your funds in a property between your personal funds and your IRA funds. So keep it all
Hey,
connected.
Mark, that can be as simple as a water bill, right?
That's right. Anything, right?
You
Anything associated with that property that your IRA owns.
do not own the property, which means you can't contribute any of your own funds, or it can technically become a taxable event.
That's right.
The other thing, and I've done a number of loans to IRAs, is you cannot personally guarantee the loan if your IRA owns the property. Again, you don't own the property, your IRA owns the property. We've had certain situations where it's like, look, Rob has a lot of experience, but he's technically not the owner of the property. His IRA is. So the lender can't come back with any kind of resource to the owner. So in return for that, a lot of times the lender will say, well, look, if you're putting more money down, I don't care if I have personal recourse. So I did a deal in Annapolis where it was just that. It was two doctors that were buying a building, and they bought it with their IRA, and we did it fully non-recourse because they were putting up a chunk of their own money. But that's important because you can't take personal recourse if you own the property in an IRA.
Yep. Yeah. Just think of it as this IRA is its own person, right?
Yeah.
Acting on your behalf, but it's its own person, and it's all got to go through them. Nothing can come from you or benefit you personally. It must all be through that account. So this slide here talks about a few other things to kind of keep in mind with that. It has to be purely for investment purposes. That means you can't use your IRA to buy a house that you're personally living in. It needs to be something that you've bought for investment. All expenses need to be paid through the IRA. As Chip just said, that's everything from utility bills to the tax bill, obviously mortgages, other loan costs, anything that relates to that property. You can't even use your own furniture in your rental property, right? You cannot take anything that is yours, be it money, property, anything, and put it into the property that your IRA is involved in. It must be strictly, your involvement has to be strictly through the IRA. And then any income generated must be paid to the IRA and not to you. You don't get to split some of the profit into your pocket. If the IRA is the thing that invested in it, the IRA gets all the money back. And then you can't use it to buy property from yourself or from your family members. Again, these are for third-party investments. And the downfall that you were looking to avoid by not doing these things is, as Chip said, having the investment disallowed for the IRA purpose. If you accidentally even do one of these things and pay for a bill out of your checking account instead of your IRA account, the government could say, nope, none of this is now tax deferred. It's all normal taxable income. And even worse, they could disallow your entire IRA and everything else it's ever done, and then start taxing the bejesus out of it. So don't get that wrong. Make sure you follow all of those rules. So
That's what
this
makes
is
me a
again,
little bit nervous when you get some of these self-directed IRA companies that give you check writing privileges, right?
Yep.
Yeah, where does it end? Sometimes people start dipping into that money and using it as personal money. I've seen it happen. So
That's right. You say, oh, it's cool. I'm going to pay it back. I'm going to make sure that it goes back in. But if the paper trail is there and you get busted for it, it can invalidate the entire IRA. Yep. It's definitely something that you need to exercise a lot of control over and self-control over to make sure that it gets used properly. Incredibly powerful, but with great power comes great responsibility, right? So this is just a little bit about who you can or can't lend to. You can't lend parents, grandparents, great-grandparents, their spouses. You cannot lend to your spouse. You cannot lend to yourself. You can't lend to your children. You cannot lend to the fiduciary and the plan provider. What is that? Children, grandchildren. You get the point. If you share the same name, probably shouldn't be lending them money. Everybody else, though, fair game. Lend them money or go into deals with them with your self-directed IRA. So then kind of getting back to one of those original points of using this in combination with your developer, you can lend a developer or sponsor, manager, whatever you want to call them, somebody looking to raise money for a deal. You can lend them money from your self-directed IRA as long as you've set it up properly, you've got a proper custodian, and you follow all the rules, and you make sure you use the right name. It's really not all that complicated, right? As we were saying, it's just a couple of page form that you fill out in order to lend the money out. Just make sure you're lending it to the right kind of person, and that you use the right name, and that you don't take any money out of your personal account while you're funding things from your IRA. And then likewise, you can borrow from other people. This is another thing that we remind people of. Like, yeah, I've got an IRA. It's it's sitting on a bunch of Microsoft stock from 1990 or whatever, and that's fine. But we like to let people know, by the way, you can roll your funds over into a self-directed IRA, and then you can now invest in other types of assets or real estate. It doesn't have to just sit in an old stock fund or an old mutual fund. You can convert to a self-directed and then use that money to participate in real estate deals, apparently buy Bitcoin if you're Rob Chevez, but do things that may be higher risk, but can also vastly increase the return to your retirement accounts over traditional investments. That's why they're so cool.
gold, silver, hard currencies.
Futures, options, contracts. If you are on Reddit or Twitter and you see the kids trying to short squeeze GameStop, you can get into that stuff with your self-directed. You can get into all kinds of trouble with a self-directed IRA. So please don't blame us if you put it all on GameStop and then lose it. So be responsible with your self-directed IRA. Just know that there can be some much better opportunities out there than just 5 or 6% on a mutual fund, and you can take advantage of those with the flexibility of the IRA. And you can take advantage of your access to people who have money to invest that don't have your ability to find deals, but they've got money by using syndication. Just make sure that your documents are drafted correctly and that they're protected and you're protected. You do it the right way, and you can use other people's money to do your deal.
Hey, Bex, that brings up a good point. You know, we should talk. We normally start the meeting talking a little bit about what we're seeing in the marketplace. I think it's incredibly valuable for a consumer to understand like what's happening in the marketplace right now compared to a couple months ago. So I'd love to just hear from people what they're seeing in the marketplace right now. And I'll go first, right? What we're seeing on our side is we've definitely seen a slowdown of a little bit of a slowdown, right, in our market. Now, it could be seasonal, it could be summertime. Summertime is typically the third, worst time to sell, right? It's typically spring, then fall, then summer, then winter. But we're seeing property sitting. We're seeing some expireds. We're seeing lots of price drops. And so we're seeing that here in the market. I did see a stat here recently that 20% less contracts went under contract in DC, right? Compared to this time last year. But I'd love to get anybody else's perspective, what they're saying. And by the way, it doesn't mean there's like a crash looming or anything. It's just, hey, it was so hot for so long. It seems to be a little bit of a retraction.
Right. So I'm going to echo this sentiment, Rob, but I will say that I don't have enough anecdotal evidence to say if this is a trend or if it's a occurrence.
Season?
I can certainly say we had a property that was coming on the market in July, and it was a flip, and it was done to the nines. It was beautiful, and frankly, it was priced under market for what I thought. And I was like, this is going to be 15 bids, and it's going to be bid up 50 grand above list price. And crickets for 2 weeks.
Where? DC?
Alexandria.
Alexandria. Okay.
It was, I would have absolutely told you there's no question it's going to go.
And this is when the investors like freaking out. They're like, what's happening?
What's happened? What did we do wrong here? So at the end of the day, it traded for 25 grand below list. And it went under contract about 3 weeks after the original list. And the idea was, okay, this was July. Was this just the fact that people could get away for the first time and they're enjoying their vacations, and for the first time in forever, they're not thinking about real estate? And it's just a blip, and maybe it's not foregoing of what is to come. So we'll see, because we have another one coming up here very soon. And I'm hearing that a lot of the activity is back, since we got into late August and now you're into Labor Day. And we always talk about the seasons, and I always talk about the 10 weeks of fall, right? Things will typically slow down in August. They didn't last year at all. But you get after Labor Day, and there's about a 10-week period up until the time you get to Thanksgiving. It's a pretty good sales season.
Great sales, great sales season.
Right.
For sure.
But you have to sort of time your project, because once you get to Thanksgiving, again, it didn't happen last year. Typically, people now are thinking about making pumpkin pie and going to grandma's house, and they're not thinking about buying houses anymore. And that can sort of preclude the slow season, which is the dead of winter.
I normally find that we're still very active in the beginning of December. So you got Thanksgiving at the very beginning, but then around the 15th, right, just like shuts off to the beginning of the year.
Yeah, and then beginning of the year, you have a property that's done to the nines and it's ready to go, and then there's ice out there. You can't drive because of snow, so people can't go out and see the property, and it just precludes things from moving in a timely fashion. Again, all of that over the last couple of years in particular had no bearing at all. Everything was just selling as quickly as it could go on the market.
Yeah, an analogy that we had today in our team meeting was, it felt like we were going 95 miles an hour, and all of a sudden we're going 65 miles an hour. And this is kind of normal, but normal feels weird in a hyper fast moving market. You're like, wait, what do you mean I don't have 20 offers $100,000 above list price, right? I'm like, okay, well, that was just this weird culmination of
Yeah.
COVID, pent up demand, low
And
interest
you
rates,
still
no
see some
inventory.
sellers that don't realize
Yes,
that.
yes.
And it's like, this property is worth 900 grand, and that's a great value, or it's a
Mhm.
great price that you're getting.
Mhm.
Why list it for $1.1 million?
Yeah.
Right?
Yeah, yeah.
And their thought is, well, you know, it's a really hot market, not a lot out there, and I think I'll get $1.1 million.
Yeah, and then
doing it for
they're hurting themselves, right? They're robbing themselves of equity. So if you're an investor right now and you're looking at a project completion in the next 15, 20 days, 30 days, you know, I think the moral of the story is don't be greedy, right? Be really smart with your pricing and don't push it. And if you're a consumer in the marketplace, putting your property on the market, understand that it's all about price in relation to its condition, location, the time of the year, the sentiment. So the sentiment's a little bit different right now. Oh yeah, the inventory. Yeah, yeah, sure. Right.
And know that this is healthy. This is a good thing. It
Yeah.
sucks for you if you're the one who wanted to get the million just because you see everything going up. Well, it should be 10% more than it was last month, but it's still healthy. We can't keep going up, 10% a month. That's not sustainable. That leads to crashes or bubbles or whatever you want to call it. I think we can all agree right now it doesn't feel like any kind of bubble is bursting. We're just returning to a somewhat more normal, healthy market where there's a little more selection. Buyers aren't desperate. And we're returning to a little more normal. Still sells, still be fine. Do the smart things, right?
It'll create a buying opportunity for investors and for retail buyers over the next, quarter, let's just say. Because I anticipate what we're going to see is just a new normal of returning to normal as opposed to this hyper crazy market that we've been in. And that's a healthy thing, like you said.
Yeah.
So we just have to be cognizant of, on the investment side of your acquisition price, because I think a lot of wholesalers have done very well here recently because it's hot potato, right? It's like, they get this deal under contract and they're just tossing it to like the dumb money out there who's willing to pay more money for it because they just say, well, shoot, I'm going to get 15, 20, 30 offers on my property, right?
Right.
Don't get caught.
I've looked at many projects where you come back and look at the after and you try to unwind how, and the borrower made money solely based upon it went up X% from when they originally went into the deal until they sold.
Well, we've gotten lucky like that, right, Mark? Right.
Right.
We've been bailed out.
And had everything held steady, they would have broken even.
Yes.
And so it's like, okay, good for you, I'm thrilled for you, but look at where you originally forecast this. Had all of that held true.
Yeah. It's when the musical chairs stop.
What do you do?
What do you do? And that's where I think this is a good conversation to have. Don't be that person that gets stuck when the music stops.
Especially as it relates to topics like syndication.
Yes.
Everything looks great when the market is ripping and no one's really paying that much attention to the operating agreement and the documents. They're not there for when things are working out. They're there for when it doesn't work out, right? So if you put your what happens if hat on, that's what you're reading through the operating agreement for. And is this fair to me as the limited investor if we don't have the expected outcome, is how you should be reading them. And it's the questions you should be prepared to answer as the sponsor if you're looking to take in other people's money for your deal. Obviously, it makes it easier for you to do your deal. You just need to be able to answer those questions when they come in about what happens if, because that's what the operating agreement will spell out. For better or worse, for fair or unfair, that's what it does. Do we have any other questions about tonight's topic or the market? Or we can take a couple minutes to talk about anything you want here briefly. And just know that, again, the point of us doing a lot of this is that we don't have to talk about absolutely everything in this meeting here. We want to be able to follow up with everybody. So please feel free to copy that. Ask questions tonight. Feel free to ask questions later. ping us later. We hope to try to be a resource to everyone here. You have seen folks like our friend Chip here, who I think would be happy to follow up with anyone who are a wealth of resource about doing these deals and funding them in the market and how you get these things done. Feel free to reach out to them as well. And then feel free to connect with us in our other channels. Rob, Facebook group, Grid Investor.
Yeah, Grid Investor Community is this private Facebook group. So a lot of people ask questions in there. There'll be commentary, there'll be deals. So if you haven't joined the Grid Investor Community, I encourage you guys to do that. We've recently launched, and I think we've made it formal, the Grid Investor Podcast, where I'm interviewing serious players from all over the country and learning a little bit about their journey and the businesses that they've built. So it follows a how I built this format.
Mm-hmm.
It's my daughter, Mark, so I'm gonna have to call her here. But we just launched, like I said, the Grid Investor Podcast, and I've got people from all over the country that I'm interviewing. We've got about 20 interviews completed. 3 have been launched so far. And you'll find.
Hey, you're back on mute, buddy. I think you've got a call coming in. There you go. You're back.
Yeah, Bex, I'm sorry. That's my little girl. I've got to call her. She's called me a couple times. So
You're not so little girl. You've got a teenager now. Who knows what she could be getting into? You probably got to check in on that.
she's 19. It's great. I know. So I will call her here shortly.
Sure, it's fine. Well, that's all we've got. But make sure that you do follow up with us. Connect with us any which way that you can. Find us on Meetup. Find us on Facebook. Find us here. I'm Mark at the CAZA Group. Rob is Rob at the CAZA Group. Again, go into that chat box on the 3 little dots. Make sure you save the chat, and you'll get all the information from everybody else that was here this evening. And seriously, reach out. Let's grab coffee, talk about what you're doing. If we can help you find a deal, get into a deal, help you be a better rehabber, landlord, whatever, that's what we're here for.
Beckett.
Look forward to catching up. Yes, sir.
So real fast, just a quick story. We'll make it a little bit light. See my ear? Can you see my ear? Or no?
Does it look a little jacked up at the top?
Yes.
Yeah, what's that about?
Friend bit me.
It's just a matter of time. If I had to choose between my ear or my limited edition Air Max 1s, I might have chosen your ear.
So my dog, which she's the sweetest dog on the planet, Mark came into the house one day. It literally chewed up his limited edition shoes. I felt awful about it. But this weekend, it was kind of, I caught her tail in the car door by mistake when I was holding her, and she freaked out and turned around and got me right at the top of the ear. So
there you go.
I thought you'd enjoy that story.
Well, no, I'd never enjoy anybody getting bit by a dog, but I'm just glad to know it's not just me. I know it's not just me. That dog hates men other than you. So
She does, man, except for this.
except for that.
Okay.
Well,
Well, cool. Well, we're going to break up here and we're going to do a little bit of masterminding here. I would encourage everybody to start coming in physically because you miss the juice, you miss doing deals, you miss actually creating community and building relationships, like real relationships. And that's what we're going to do right now. So take care, Beckett. Thank you so much for leading us off. Sorry, my internet was a little wonky. We'll have to keep rolling through.
we'll get there. I think another month or so, right? We'll be in the new space, and then we'll make sure we've got hard lines and great internet and all that stuff.
Yep. We'll do it via phone. Seems to be working just fine via phone.
Yep, working good. All right.
Okay.
Good deal.
Cool.
Thanks, Mark.
Take care,
Thanks,
Mark.
everybody. Have a great
Thank you.
night. We'll catch you at the next one.